Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with Bruno, my friend, who's going to be talking about the Rhino trade. Before we get started, a quick disclosure: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that, I will stop sharing. Oh, wait, I didn't share my screen. But anyway, there's a disclosure. Let me just pop it up here just for completeness. And you should be able to see it. Bruno, let me know.
Yep.
Okay, so there it is. If anybody has any questions, again, it is for educational purposes only. Go ahead and pause the recording and read it in its entirety if you so choose. So with that, now I can switch the presenter role over to you. Sorry about that.
Okay, so...
And there you go.
Right.
And while that's coming up, it's good to have you back, Bruno. Bruno and I go back a long time, so it's always a pleasure to have Bruno. You probably heard us talking before the meeting started. But the Rhino's doing great. You told me about your personal performance this year. It's fantastic. So I'm sure people will get a lot out of this. So thanks for being a presenter, Bruno.
Thank you, Tom. Yeah, it's been hard work, but I'm pleased to say yes on my performance on the whole account, including some costly hedges and spare cash, etc. I was up 1st of July, 19.59. So. With this type of strategy, we aim, and I suppose with most similar broken wing butterfly strategies, we aim for 40–50% a year, but that's usually the stated performance. Then it depends on how much cash you leave on the side. So, and considering it's been a pretty, not I would say tough year, but annoying start of the year or annoying last 12 months, it's not too bad. But it's been more hard work, and it's probably how would I put it? Not deceived, but disappointed a few Rhino traders that we had to change the guidelines a little. I'm using not a PowerPoint, a keynote presentation, which is basically part of a course I'm building. So this is. So I will recap it because obviously some of you may have not seen the few presentations and roundtables I've done. So here's why name the Rhino, because on this broken wing butterfly we use generally a calendar hedge on the upside to protect from up movements, but as we will see, I've had to change some of the hedging techniques. Okay, let's start. General assumptions. I only trade the regular monthlies, so the third Thursday, Friday of the month. It can equally be traded with the other monthly expiration, and it can be done on weeklies. So it's a trade that is quite amenable to scaling the way you do on the RTT. And there's of course also a weekly version, which is a bit of hard work sometimes, but it uses the same concept. So somebody who is quite familiar with the monthly Rhino can use the same thinking, the same concept to trade the weekly. On the red, we use the 10-point strikes, and on the SPX, we could use the 10-point strikes as well, but I decided to only use the 25. So it's probably a little bit less flexible, but it's the liquidity is better, and for some of us who want to trade larger accounts, the fills are definitely easier on the 25-point strikes. Just to maybe point out the little differences or the update of the guidelines on the slides, I've just used a little diamond and to show where there may be something new to look at, especially for those who are already familiar with the Rhino as it is. So let's recap quickly. For the rats, we enter a 5 broken wing butterflies in a 50/40 wing size. The upper longs are placed just above the money, 10-15 points. In a relentless market, sometimes to save a little, we try and place the upper longs closer to the money, but in practice, the ATM puts can be very volatile. So it's not always easy to get a very good feel when you have your an option in your combo right at the money. It's possible to use the larger wing size to make it a bit more peaceful. I would recommend staying more or less in the same ratio in terms of PCS to PDS. In the original Rhino, and then maybe I should I've put a little diamond there. The original Rhino used to, said that it could be started 77 DT or even before, even earlier. But Brian Larson, the original designer, generally started around 56 DT. But if you start later, it's more expensive. You deal with more skew, so it's not always so easy. So I would say the earlier the better. And like most of those structures, it's better because we should not forget that we're selling volatility. So an IV pop is always preferable, even though in a very erratic market, sometimes it's not that easy to find a really good entry point. So we deal with the market as it comes. This is a standard. I'm showing only one put broken butterfly. So just to show that for the rat, generally the skew is more moderate. So it's actually easier on the wrestle to start with a flatter T+0 line. But since October, November, because the wrestle was a bit too wild for my liking, I switched over to SPX. So I'm using the SPX, but as you will see, it's not exactly the same animal. So for SPX, and you see there's no diamond here. So this is the SPX that was prescribed by Brian at the time. He uses a 80-60 put broken wing butterfly using 3. The concept is the same. You also place it. You place your longs is about 1% above the money, and it is possible to use wider wings, and that's actually the version or variant I've actually settled with. I'm actually now using this type of Rhino, which is wider and calmer. But obviously, wider wings means it's a little bit more expensive than the regular 80-60. Otherwise, as you can see, it's basically a copy paste from the wrestle slide I just showed, so it's more or less the same. This is just an example of the put broken wing butterfly SPX. As you can see, when the IV is very, very low, the skew is enormous. And that's basically the market we've had to deal with for quite some time. So this means that, it's also a trading style. Some people are quite happy trading with that environment, but it's for peace of mind. It's actually less stressful to know that you've entered and your position will just grow nicely. You don't have to I shouldn't have entered feeling the day after. So of course it can still happen, but I always enjoy a slow start, so a quiet takeoff. So this is as I said, I favor the 100/75. So it's a wider thing. I can't see my mouse. I don't know whether you can see a cursor moving, but I can't see my mouse. Anyway,
I don't see your mouse, Bruno.
yeah,
Oh, wait, there it is.
well, maybe you see it, but I can't see it on my screen. So
It's the upper left.
upper
No,
left.
it's under. Okay, yeah,
so,
it's moving around.
yeah, I can't see it on my screen. There's something I don't understand. Anyway, obviously, again, if you start earlier and if IV is stronger, higher, you have less skew to deal with, and it's a lot easier. So, as I said, in the last 6 to 12 months, it's been a fairly difficult market. Another thing is that by restricting to 25-point strikes, you sometimes don't find the perfect strikes for your. So you mix and match. For example, if 1% above the money is in between 25-point strikes, I will generally go for one just below and one just above to average out. Another thing that I have also done to keep the skew, basically to start with a flatter T+0, is to mix and match sometimes a 100/75 wing butterfly with a 100/50. So basically the average PDS side is actually smaller, shorter. It costs a little less. Obviously, it hedges a little less as well on the downside, but it protects the upside more. So, and in a grinding market like we've had, it also allows delaying sometimes the upside adjustments. So just to recap, SPX exhibits more skew. It's more expensive. Generally more tame. Maybe it's a bit of an exaggeration, but I've seen in the last year or so, maybe even 2 years, more and more people who've been regular Russell traders move over to SPX, even though the fees are a little higher. But I've tried to go back to the Russell recently. I've done okay, but SPX is hard work, and even recently Russell is harder work. And I believe on the RTT, you also moved from Russell to the ES Future. So I'm not the only one to focus more on SPX. So.
That's right.
So if we recap, it's a slightly bearishly positioned Brooklyn butterfly. It's naturally resilient to a 3 to 5% drop, and that's where actually the skew can be your friend. You have more protection on the downside thanks to the skew. That being said, it's all a matter of trusting the modeling, and in the recent month, maybe 2 months, I've had more difficulties trusting option view. Maybe the modeling doesn't really take into consideration moves. I mean, obviously, the Vega is a first degree derivative. So starting from a very low IV base, I tend to believe Vega is understated. And I've seen every time we've had a vol pop, the skew looked like, okay, great, I've got a -20, -30 delta, and the vol pops all of a sudden, and my delta is almost flat. So I would say modeling in this type of market must really be taken with a pinch of salt. It's not that easy. But I tend to believe, and I got some acknowledgement from option view support, actually even last night, that they may accept that there is a bug within option view. But I haven't actually. They offered me a fix, which I haven't tried yet. So in this market, we take advantage of obviously the limited risk on the upside. So it's a matter of now finding the right hedge for the upside. We haven't really, in the last 12 months, we didn't really have to be bothered too much on the downside. But I will show that on some occasions I do also add something to the downside. Capital management. So first, if we start 77 DTE, that's about 11 weeks. The previous trade, the previous cycle is 49 DTE, and we may still have the current month on, which is in its I would say descent phase. So in this low IV environment, we may have up to 3 cycles on, which makes it more difficult to manage money. But I have decided not to change the planned capital. It's always easy to add more money to the game, and of course some of my subscribers have deeper pockets, or they'd rather not be too bothered about planned capital, but I'm very, very strict with that. But all I want to say is that because of this environment, either you start later to have less of a lapse, but then you deal with more delta, more hedging, or you start, as I said, early, but you have to scale in and out other positions to move capital. So basically, even though I'm not going to be talking too much about this right now, in effect, scaling is borderline coming into layering. So I think in the next version, we will probably be allocating capital a lot more smoothly over cycles, so that we like to kind of plan ahead instead of reacting, because but so far we've managed to do that, but it's a bit of hard work. And I would say that half of my adjustments in the last 6 months are not actually motivated by the strategy itself, but mostly because if we want to respect the cycles and get into the new cycle, well, we have to take money out of the existing trade. Just to add, okay, we scale in. I mean, it's part of the original guidelines, but I just want to add this slide because as you can see, there are 2 little diamonds. In the original Rhino, the rule was to add capital into the trade if the market was actually leaving the tent. The underlying was leaving the tent on the upside. So that was one way of flattening delta and getting a little bit more theta. Obviously, you lose theta if the SPX or the RUT shoots higher. In my version, although it's not going to be, it has not always been easy for the reasons I've just mentioned, i.e. Scaling in and out. Even if the market does not move out of the tent, I add another tranche, another batch. Or so for the Russell, we add the same 5 put butterflies. So in the original rules, it was to be put just above, about 1% above the, maybe 20 points, or sometimes even up to 30 points above the original structure. But capital allowing, I've decided to actually use capital better by actually always scaling in. I always want to go into full size. So within the planned capital, we can add another 5 put butterflies on the Russell. And for the SPX, the original 8060 Rhino butterflies, we use exact other same tranche of another 3 8060. The concept is the same. I mean, it's kind of a copy and paste of the previous slide. So it's always 1% above, sometimes a bit more. That's why I've said average 25, 50 points, because it can be basically you use that scaling as an adjustment. You want also to use that as a way to flatten your T+0 line. And for the same reason of better capital usage, assuming that I don't have too much being used in previous cycles, I try and add those additional flies to add theta to the trade by 56 DTE. So what I usually call the 77 to 56 the takeoff stage. I mean, that's you try and get your trade into place, and have a maximum capacity to then capture premium between 56 DTE and something like 35 to 28 DTE, and that's the last stage is called the descent or approach, to use the jargon that pilots would use. So as you can see, the little diamond, same as Russell, also want to use capital efficiently, which is of course sometimes a difficulty. So because the 175 Rhino is more expensive, we can't do a 3+3. We only do 3+2. So full size is five flies and not 6. Otherwise, it's exactly the same. So what I want to say here is the tranches 5+5, 3+3, or 3+2 are not exactly an exact rule. Not only you may not have the capital available, but sometimes you're a bit uneasy with the market, and so I still think it's important to get skin in the game, get into the trade, but there's nothing wrong with starting with 1 or 2 to test the water, and then maybe a week later. So because if you scale in to full size on a strict alert, like your the underlying has left the tent, yes, then it's quite simple. But at the same time, it's sometimes not that enticing, because you want to add expensive flies with the market going up, so your flies are more expensive. So it's a bit of a dichotomy or schizophrenia, so to say, because you want to enter your flies when the market goes down, which usually a vol pop, and then this rule tells you to add into the game when the market is actually going up, and sometimes even shooting up. So there's nothing wrong with going one by one if you have the time. So it's also a matter of trading style. If you don't want to think too much about it, just enter your trade. If you're a bit more hesitant, go for it. But there's nothing wrong with scaling to full size of a week or 2 weeks, and even more if you have a large account to trade, where in any case it's always better to add tranches, sometimes just to feed the market with a maximum of maybe 100 or 150 flies. It's actually better to go in and out more gradually. And as I said, this market has led to a lot of scaling in, scaling out, which is basically capital management more than a strict strategy rule. And it makes sense now to do what you do on the RTT, which is maybe a more continuous layering, moving capital to the next cycle. I know that some Rhino traders would like to keep it as mechanical as possible, and I wish it would be possible, but I have a little caveat here, is that when I took over from Brian, well, that was just over a year ago, Brian gave me all his back tests from 2013, 2014, and not only I saw that it was a little bit too relaxed with planned capital, and I'm very strict with that. And also, I think it didn't do that well, chasing the market. Sometimes using a calendar and then adding a calendar hedge on top, and then the market just leaving, going past the horn of the calendar, adding more calendars on top. So, and it's just not me. It's not my trading style. I don't chase the market, and that's why I am more into, as I said, removing the calendars and going into RTT style. So just a recap on the adjustments. On the upside, we use call calendars, generally about 1% above the market. It's call calendars. I understand that quite a number of traders don't like horizontal spreads, don't like calendars, and it is true that call calendars can be a little bit more tricky than put calendars. The call skew sometimes is a bit weird. So that's why there's another variant called the white Rhino, where they use call flies, called broken-wing butterflies. To be honest, I don't use them. I still think that by using a calendar, you mitigate your vega, and even though a call calendar cannot be seen as a downside hedge, it's clearly an upside hedge. If we have a very strong vega by a strong reversal, well, I believe that it's better to keep your vega in check. So to have a flat or flattish T+0 and a lot of vega, I mean that's to me it's a possible danger, but not necessarily for a long time. I mean, but for a while you can have your profits sink because of a huge pop in volatility. So I have used a lot of PCS and PCS rolls. So I basically, when the market goes up, I just sell more premium. So depending on the market, you can place your PCS at different levels. It is reasonable to place them close to the shorts, but if you are very, very bullish, you can actually start doing reverse Harvey. So basically placing your PCS at the upper longs. Something I hardly ever do, but I've had to do it for this July cycle, is an entire rollover. The reason why I don't like doing that is, first, it's costly. I mean, you take a loss on the fly, and you just position another one, and the other one on top is usually expensive. But also, it's also a matter of trading style. If you add a call calendar, if you just add PCS or even more, or even better, PCS rolls, you don't rock the boat that much. Your Greeks still look in a fairly good shape. When you generally do a major change to your structure, your Greeks are, I wouldn't say messed up, but it's a very different dynamics. Of course, it settles and you get used to it, but I'd rather have a softer adjustment whenever possible. On the downside, you remove the calendars if you had some. You can obviously add PDS, and most of the times the exact opposite of what I just said about the upside. So you start moving your shorts down one strike, and of course it's advisable to have a hedging technique on the side, but which I have built recently. Actually, at the moment, a hedge trade is very, very cheap. I mean, the IV is low, so I mean I won't get into that. It's something I'm building, and I'm offering my subscribers. I mean, and I will come up with guidelines later on. But that's a little extra. So on the upside, the typical adjustments is that you want to, when you well, it's actually upside's -5 delta and -10 delta, so the sign is wrong. But basically, because now we've in the recent month we've used scaling a lot more. Sometimes I don't get to full size. Maybe on a typical 100/75 fly type of structure, I may, because of capital limits, I may just have 4 flies in that month. So instead of having a strict, as it was for the original Rhino, it was, if I'm not mistaken, it was 25 half size and 50 full size for SPX, for example. So full size, so roughly about 10 delta per. So now that sometimes the position is not full size, I try and monitor the delta per fly, and then I multiply by the number of flies I have in the market. So you can and you can reduce that outside the tent. So you can start adjusting quicker if your delta gets too high outside the tent. On the downside, I have not changed the alert level. Still about 25. I may be a little bit more lenient if we're above the short. And as a guideline or something I keep in mind all the time is I believe the rhino must produce in between the horns. So I will not let the market actually. We haven't had a major fall in the last 6 to 12 months, but I would not, regardless of delta, I will not let the market go past my main structure, my butterfly horn. That's why I say always flatten delta if underlying passes or threatens to pass the horn. Something that is new, and again, it's a more personal trading style for the simple reason that also I believe it's better to I wouldn't say to know what you're doing. Of course, we're supposed to know what we're doing, but we are flight traders. We trade butterflies. Calendars are a different animal, and especially on the upside. And my view is that I would not chase the market. I never chase the market. As I told you, I would rather use in the takeoff stage, use a scale in to maybe follow the market, reduce delta, have the most flattish T per 0 line. But I still trade flies. I still want to trade butterflies. So if it may be a different story if you use more call butterflies on the upside as a hedge, because then you may choose to use it as a second part of your structure and trade the hedge as you would trade your main structure. But it's a mindset, and mine is I trade my flies and I don't trade the hedge. So I'd rather, and I understand that in a very low IV environment, rolling calendars, it's generally not costly. You just move your calendars higher, that's fine. I mean, you will probably just keep the tent going, and you will probably not lose on the rollover. So it's not as costly, or it doesn't really shock, so to say, the Greeks that much if you do that. But it's a personal preference, and I personally don't do that. Brian Larson used to do that more, but I don't. So also because call calendars, and that's something that Brian Larson pointed out in the original guidelines, may be tricky to trade later, especially in the descent phase. So from 28 DTE to expiration. So he recommended to then substitute them for actually cold Brockenry butterflies. And I thought that, well, it's probably easier just not to do anything. So that's where, when the market starts going up, I'd rather close the calendars, start applying reverse Harvey, and then so to lift the upper expiration line. Then it's a matter of adjusting your delta, but also your vega, because once you are into an RTT mode, you basically lose your vega hedge that was in the calendar. So then again, you must be aware that in case of a sudden reversal, you may be hit. So unlike the RTT, where you can sometimes go delta positive, even in reverse Harvey, so basically applying some PCS on the upper longs, I would still do it very conservatively to keep some negative delta at all times. Since I've been talking about capital management and in scaling, let's recap on planned capital. Always use 25K per cycle, calculated with Reg T. So that's why we can afford up to 10 flies for the rut, 6 with a 8060 SPX fly, or 5 for the wider version. In the Rhino class, I have when we come to the descent phase, so about the 35 to 28 DTE, I do a spin-off. So because usually by that time, either I've got 25K and so I've got little left to start another trade. So that's why I usually start scaling out. But for people who are on PM, I do spin off what I call the extended trade, where I keep that $25,000 per cycle, irrespective of overlaps. So the planned capital, as per the original guidelines, which I haven't changed, even though, as I said, it's more complicated in a very low IV environment, and I don't want to take it easy and just add more money into the trade. So, and I think learning to scale out, or even layering is actually a good experience, and eventually IV will come back and we will be a little bit more comfortable with the planned capital. So yes, it's a bit difficult at the moment. So Brian recommended using 1.5 times the max capital to prepare for overlaps. Of course, if you want to, as I said, if you want to trade strictly 56 DTE to 28 DTE, then you can actually trade with less capital because there will be no overlaps whatsoever. But in this market, I don't think, and it's going to be more work in the end, because if you really want to enter and close trades like clockwork 56 DTE, sometimes it may make little sense, because the entry point will be just a bit random. So I would say this amount of capital in 2015 type of market, early 2016, that was fine. It's a bit tight at the seams at the moment, but hopefully it will be better. So as I said, the 25 and the regular, it's actually, I've got two variants. I always start with the regular Rhino, and when it's time to scale out, so reduce from 25 to 20, 18, 15, I keep it 25K for those who want to trade the extended trade. The extended trade I take close to expiration, or sometimes even right to expiration. Okay, that's where, I was ahead of a slide. So here you can see the extended trade takes 25K per cycle, irrespective of overlaps. What I want to say is that to be fair and to benchmark this type of strategy and compare it with a lot of different strategies, the M3, Kevlar, whatever. We use the Reg T type of planned capital, but what I want to say is that even when I use the extended trade, which is more suitable for PM accounts, I still never exceed the 37.5K of capital. What I want to say is that, because I know that PM margin tends to increase over time, so I will also scale out an extended trade, so that if I've got 3 cycles like I have at the moment, so I've opened September, August is in full swing, and I'm actually about to close July, the July extended. I still make sure that overall I never use more than 37.5 of capital. The strikes I've talked about again already. Prices that this is just a reminder for maybe beginners. Yes, when you enter your trade, it may be tempting to go closer to the money. As I said earlier, to get your flies, the upper longs of your flies, closer to the money, they will be cheaper And I have to say that I've done that, but I would certainly prefer entering when the IV goes up, when it ever goes up. I mean, it's been a bit difficult. I think you've seen a bit too many slides, so I'm going to maybe show something on option view.
Sounds good. There's been a couple questions in the chat too,
Oh,
Bruno.
gosh. Oh, sorry, I couldn't see them. Sure, go ahead. What are they?
Oh, let's see. Let me scroll back up. First one was, are you scaling in the same expiration cycle or the next available 77 DTE?
Well, that would be more like layering. No, at the moment I stick to my regular monthly cycles. So, but it can be done definitely. For example, the September trade, I've entered 2 flies because I was a bit short of capital. So since I'm about to close the July extended, I may actually buy. I could. I could. I'm not saying that I will do that, but I could certainly mix it with the month end September to build that trade over 2 cycles. So getting into some form of layering. But at the moment, I don't do that, but it's quite possible. I mean, there's no difference.
Let's see. Next question was downside flatten if passes the horns means if passes below the center strike of the first broken wing butterfly.
Yeah.
I think that's
just
a I think that was just a clarification.
Okay. Yeah.
And then
Okay.
the last one is if you have / want to use more than 25K planned capital, do you recommend multiple trade structures or just an increase in the number of tranches to for liquidity?
I stick to rhinos. I sometimes do more freestyle trades. I would say do what you're comfortable with. I mean, if you trade different trades, it's more work, but it's a different logic, a different. So it depends if I understand the questions correctly, it depends how comfortable you are with an overall butterfly strategy. But otherwise, I stick to rhinos. If I've got more money, I add more tranches. I don't know if I'm clear enough.
Okay, that's it for the questions.
Maybe just to show performance, let me show off a bit. This is my track record. On the capital discussions, the performance is calculated always on planned capital. And I think and a lot of traders, we like calculating performance per cycle. So this is what I've been doing since November, where I think late last year I traded both Russell and SPX, and then as of November I have only traded SPX. So performance has been pretty good. Year to date, probably about 32% on the extended trade and 24% on the regular trade. Those figures are from last night, maybe a bit lower now with the market shooting up. But it's not too bad. I mean, I'm doing fairly well, and as I said, pretty stable. Not a single negative month on the extended trade. It's also a principle, a key guideline in my mind, that it would be too silly to let a trade lose on the upside. I mean, it's something I just can't accept. So that's why I'd rather. I mean, you can hedge the trade, you can be more active or less active. I could probably do more if I was really trading the hedge, but that's another of my principles that I shouldn't be chasing and trading the hedge. So I generally you take the trade into an RTT, and it maybe takes a bit of experience. It's actually pretty good to have some experience with the RTT to understand maybe the vol skew a bit, to actually time when it's actually adequate to do a reverse Harvey. But overall, if you know what you're doing, as you can see, you can do a stable 3, 4, 5% on each cycle. There's a bit less recently, but hopefully it will come back. So let me show you Oh, well, the market is stabilizing. So just show you what's left of my July extended. Actually, what I could have shown you earlier today or yesterday is that exactly what I told you earlier is that when you have a very flat delta and you've got some vega, obviously vega is now being reduced as time goes by. I mean, it's almost like it reduced. It comes down naturally with theta as time goes by. Vega also goes down. So, but generally, in the last 6 months, I have found that for a normal structure, I would say around 40, 50 DT, you know, at cruising altitude, I've realized that by keeping a delta vega ratio of 10% was cool enough, and it was again. It's still sensitive to a sudden vol pop where your delta will suddenly flatten, but overall, it was a ratio where I could capture my theta, although it's an expression I don't like, but I mean capture premium by keeping a bit of a slant on the T plus 0, but something that's pretty much stable. I mean the P&L was actually not that volatile. It's exactly what I was looking for. You don't, I mean, okay, sometimes you get caught and you get some position drawdown. I'm not saying that sometimes it happens to me. I mean, even in this position, when we had that dip in May and then the sudden reversal, in which for it's a very, very rare occasion, I had to roll over an entire butterfly. But generally, by using a 10% delta vega ratio, we had very, very stable income. The profit and loss going, I mean, slowly up. It's only when I had to roll over that fly and I disturbed the dynamics of my position that I let this trade actually lose a little bit. Another thing that sometimes is that when you have 2 or 3 cycles on, and of course you want to focus more on the one that's going to expire first. So sometimes you don't pay enough attention to a trade that's got more time to be fixed. So this July trade, it was actually in May, this trade was young. We had to look at the June trade because it was really being jumping like a roller coaster because of the directions. So sometimes you let a trade, lose a little bit. So I allowed this trade to actually lose for a while, but as I said, I always managed to get it back on track. So this is how the trade looks. As I said, it's the extended trade. So capital allowing, I would certainly let it expire, but I may have to reduce it a bit further to put some more money into the September trade. But if I show what the trade was looking like yesterday, and let me put the back trader at the close. It was certainly doing better. Yeah, it was plus 800. Yeah. Okay, something that I wanted to show by using the back trader is that I closed this morning the put calendar. Why did I put a put calendar, which is not in the original guidelines? Is that exactly for the reason I mentioned? If you have a very flat T plus 0 and you have some negative delta, let's assume that no, well, this was yeah, it was there. If I didn't have that put calendar, the T plus 0 would be flat, and it's a time where I want actually to be able to, without any stress, to close my position at any time, because I feel there's an opportunity in the next cycle. So I don't want to then be stuck with the trade and wait for, even though, yes, theta is pretty strong and it can pick up very quickly. But if I didn't have that put calendar, I would be delta positive, which I don't like, and a delta Vega ratio, which to me is a little bit too risky. So that's why if the market just tanks, you're going to hang in there, hoping that as each passing day you get back your profit. I just don't like that. So yes, in comparison to original guidelines, I have had it sometimes a Vega hedge on the downside by using put calendars. I've done that. It's obviously easier when there's a predictable event like the French elections. The position was actually very, very fine, but I decided, okay, I'm going to hedge my Vega with a put calendar just in case. And the trade, I'll probably close it at cost. I didn't make money on the hedge, but to me, the point is not to make money on the hedge, but it's just to make sure that your trade is safe at all times, especially because now, as I said, I may or may not let it expire if I've got enough capital to leave it to expiration. But if I don't, I don't want to then to stress out and wait for 1 day, 2 days because Tether's going to kick in so big that I'm going to make my money. No, I don't want to do that. Any trade must be in a position to be closed if need be at any time. Let me show you the August trade, which is now at cruising altitude. This one has been suffering a little bit as well. So in this trade, I've put I've actually hedged it with call calendars when the market was shooting to the recent highs. So my delta is a bit strong. It's not exactly my preferred delta Vega, but it's all right. So this trade was doing probably about $500 yesterday. That trade is still okay. What I will probably do, although my planned capital is getting too close to the limit, so that's why I think I've got 4 flies in this one. I couldn't afford to put a 5th one for the reasons I've mentioned. But I will probably do a PCS roll. I can't actually add a PCS. It's going to cost me money in terms of margin. So my next adjustment is probably going to be a PCS roll. So I'm going to move this up lower longs, something like maybe 1 or 2 PCS rolls as we go. So, but as you can see, of course, delta is a bit inflated by the low volatility, and I'm sure the IV was popping back to 10. My delta would be flat, but that's the tools we have to so we have to deal with that. So what I want to say is that I try and keep my delta flatter than most similar fly structures or fly strategies. So, and again, even though yesterday, my profit has gone down a bit, I'm not too worried, and it doesn't have huge fluctuations. So, I would say it's one of the no trading. It can be stress-free, but it's actually probably the less stressful strategy around for this type of butterfly strategy. And just to show you another example, this is a September trade. This one is losing a little. It's still early in the trade. We still have 65 days. And as you can see, I didn't have enough capital to put a full tranche of 3 flies. I've put only 2. And this is also an example of what I said earlier, that sometimes because the skew is so strong in the low IV environment, it would have been stressful is a bit of a misnomer. But let's say you would have more upside risk. You take a chance of adjusting quicker. So yes, I've put a standard fly 100/75, but for the second one I used a 50 wide PDS, and this is how it looks. It's very flat, and that's the way I like my trades. So of course, since I only have $8,000 into the trade, I'm releasing money from the July trade very shortly, so I will scale in. And as I said in the presentation earlier, I try and get to full size or close to full size by 56 DT. So we're still in the preparation, takeoff, and ascension. We're not yet in cruising altitude, so a little bit more work can be done to this trade to add more wide details. So when I've got sufficient capital, I may do something like this. Yeah, as you can see, I would add I would be 24, so it's 8 delta per butterfly, so that's acceptable. And let's have a look. That would be perfect. Obviously, we do have a bit of upside risk, but we used we used already a shorter wing. One of the three is actually has got a bit more protection on the upside. Got very little delta, so we've got time to let this trade grow. So we don't have, even though we're in a very low IV environment, this scaling comes a little late. We would like to have our trade in full size earlier, but we don't have to rush having a risk of delta going high too quickly and having to prepare for a hedge too quickly. And again, if I believe the market is going to be in a complete mad breakout mode, shooting for the stars, I may actually just do what I've done earlier this year, i.e., forget the call calendars and just do PCS rolls and basically go more RTT style right away. Right. I don't know if are there any other questions?
There were a couple. Maybe you want to pull up the chat. Maybe easier than me reading them. Just go up to the top of your screen.
Right.
And you have that drop down.
Chat, yeah, got it.
And I think the one you want to start with is from DG. If you find as many as 50 to 60 DIT.
Yeah. Oh, wait, where's that? Where does it start? Okay, the first question, 90%, Andrew, PCS. Oh, yeah, sorry about the jargon. Yeah. Plan capital. Oh, thank you for all this, yeah. Okay, yeah. If you had as many as 50, 60 DIT, how
will you trade?
Yeah, how were you able to enter next monthly cycle? Or do you have to close it? Well, I calculate more DT than DIT, but yes, if I feel that the trade has potential, I may leave some of it to expiration. But yes, the capital management is paramount. I would love to get my July extended trade to expiration, but if I feel that now it's time to scale in for September, yes, I will close my July extended. So yes, I do have to do that. It's been my experience. If you have the capital, you can have multiple cycles open. Yeah. I thought Bruno said he doesn't do any layering. Well, I scale out, but I still look at trades individually. I think of layering, and you can do that with option view. You just use a master account and you combine your trades. And that's something. It's a different trading style. I can do that, and actually I do monitor. I've got a master account. Where is it? My SPX Rhino master. Where somewhere. Oh, Rhino master. So yeah, I do look at that. So if I was doing layering, I would then look at the overall trade and do more fine tuning. So that's and moving across cycles. But that's more a more advanced trading technique, which I'm not doing right now. But yes, it can be done. I keep it at the back of my mind. So but it's not something I actively do. because I don't want my subscribers who feel it's going to be too advanced. I don't want to confuse them. If you're initiating September SPX add-on trade, which strikes? Well, I just showed what I would probably do. I would certainly look at price. If the trade I've just shown is too expensive, if I go back to the September trade, this additional fly is probably too expensive for my liking. So, but I will look. Also, something obviously a volt pop, because we make. I mean, PDS costs money. We make money from the PCS side. I mean, the PDS side is only a hedge on the downside. So you can choose. That's why sometimes I go for a shorter PDS side, because I feel I need less protection on the downside. But also look at for example, if we are 2440, I will also look at the Vega behavior of the PDS side. So I look at price and I look at this, and so because if the market, I mean, if the vol is very low, the PDS side will be very cheap. So I look at where you know that when the underlying is at midpoint, the PDS is basically Vega neutral. So you adjust your trade or your entry purely on the delta manner. So yes, I do that. It's also, I used to trade my flies with individual spreads, but since I've been running the class, I've decided not to do that. So I basically enter simpler structures, even though Broken Wing Butterfly is actually a bit harder to fill. You lose 10 cents every time compared to individual spreads, but not everybody is prepared to take the risk of the market moving in between your two trades. So why did you choose the 2475 strike as your long instead of 2450? Well, it was just top of my mind. I mean, I will look at. I still believe 2450 is a current high, so I may go for 2450 and instead of 2475. That's for sure. Yeah. But you buy some theta. Again, it's also when I look at entering a scale-in, I want to make sure that I don't. Obviously, what is important for me is that by adding additional flies, I don't get right away into alert zone for the whole structure. It's just peace of mind. There's something that is called in marketing is called cognitive dissonance. Oops, I shouldn't have bought it. And nobody wants that in trading. I mean, you don't want to have a second thought. And a lot of beginner traders have that negative thought that I didn't get a good price. I entered at the wrong time. So at least by keeping your delta as flat as possible, if you make a little mistake, it won't cost you. I mean, it's going to be fine. If you start and because of the skew, you're already at alert level. Because let's say I put on this type of it's still all right. I'm still below my. If I take into account my delta alert of 10 per fly, with 3 flies I'm 25. It will still be okay. But and I assume that if IV picks up again, it will flatten this delta. So that's probably still all right. So I will look at price. I look at my delta, and also something as I said earlier, I feel relatively comfortable with about a 10% delta Vega, so it wouldn't be too bad. So I may go for it, even though I would probably find it too expensive. If I go for this one, it's probably too expensive. But so I'll probably keep it in mind, and I will look for. It doesn't matter if I enter it today or next week. 1290 is a bit expensive. I sometimes cave into, but I'd rather pay. I mean, I used to pay less than 10, and then I already accepted sometimes paying 11, but now it's really, really expensive, really, really expensive. So it's not exactly a market that's very enticing. So I hope I've answered the question.
Yes,
Do you?
and I pasted the link in if people want to do the trial or try out the Rhino. But there was one question about the alert service. Do you send
Yeah,
SMSs before you adjust?
yes. I remember, and I won't name anyone, someone who's just sent order and then fill. I'm trying to be nice and not to stress people out. So the message sequence is always plan, order, and fill. So you have time to plan it, to prepare your spreads. You have time to think about it if you want. So I don't take anyone by surprise. And to be honest, a lot of my subscribers get better fills because they use my trades as a benchmark to get a better price. But that's fine. Do I use Skype? I do have a Slack team. I use Slack. Where is it? Yeah.
I've actually been looking into Slack for all the trade alerts, but haven't quite gotten very far with that.
Yeah, it's actually pretty good. So basically, I've got some open channels, even one for froggies like me. And two channels are restricted to class members. The weeklies for the baby rhino and the main structure. So it's actually better because we can chat, we can plan. Okay, like this morning we talked about Janet Yellen's speech. So I post the same messages as with the alert service, but I sometimes help someone. Like I had a guy asking me what are the differences between OV and IB. So it's just more general assistance. I planned. I mean, I've got to hear the same Rhino planner as with alert service, but there are more discussions, and I would say that my thoughts leading to the plan message I share quite openly. So yes. So the only thing is that there are two restricted channels, yeah, which are the most active. The other ones are not that active. There's one channel here called Hedges, because something I haven't had time to show, and it's a bit off topic, is that I have started building a Vega hedge, and this channel is soon going to be moved to restricted area. But because I'm still working on the guidelines, it's a bit of an experimental trade. But maybe I can show you my hedge trade quickly. I don't know whether we've got time, so you stop me when you want.
Yeah, we're a little over, so maybe that would be
Okay.
good for
Okay.
another time.
So
Ivan
it's
did ask a question about what time do you use to adjust, before 9 a.m. West Coast or after 9, which I guess would be what, noon Eastern.
I tend to place my orders around 10 a.m. Eastern, and also very often we're done for the day, but sometimes I also show also something some possible adjustment to execute by the close. So this is my hedge trade. Obviously that's for the July, and just quickly, this is how it looks for August. So I always try and keep anyway. That's for another discussion. But this is something, and I think it's a good time to start preparing for hedges. Yeah.
Yep.
The
And last
market.
question from DG: can you share the Slack channel link if there's an open public one?
Sure. Where's invite people? Oops. Copy. To all participants. There you go.
Very good. I will put that with the recording too.
Okay, great. Oh, it's only valid. I mean, anyway, you just contact me. I can actually.
Yeah, maybe that's better. We'll have them contact you. Yep.
Yeah. Okay. So I've got an email address, or I don't know whether people can contact me through Capital Discussion if they're not member of the class. But anyway,
Yeah, just send an email to support. So support.
Oh yeah, that's perfect. And so
Yeah.
Tom will forward it. Yeah, that's cool.
Yeah, I'll just put that in there.
Because
All right, Bruno.
Okay, cool. Thank you, and sorry for taking a bit more time.
Oh, no problem. It's always good to let an interesting topic continue a bit past an hour. It's worth it.
Okay.
So
Thank you, Tom, and thank you guys for attending.
Yep, and again, if people are curious about the Rhino, go ahead and go to Capital Discussions to the sign-up page, and you can do a 15-day trial. Or if you've seen enough and you're ready, just go ahead and subscribe. And it's a great trade. Bruno does a great job. Really good communications. We've had lots of good feedback from people, and give it a try and see what you think. So thanks again, Bruno.
And as you can see, I'm very conservative. The Rhino may appear as a more risky trade, but my track record shows that I'm pretty much conservative.
Yep, it's the way to go.
Okay.
All right. Well, have a great day, everyone, and we will see you next time.
Thank you.
Thanks.